Hello everyone and welcome, my name is Ian, and today I'm going to explain to you how dividends are taxed, what the difference is between ordinary and qualified dividends, and how to tell if your dividends are qualified or not. So let's get right into it. The first thing that you need to know is that there are two types of dividends, ordinary and qualified. Now the difference between the two are the rates at which they're taxed. Ordinary dividends are taxed as regular income and thus are taxed at the marginal tax bracket specific to you. So if you make $30,000 from your job and an additional $2,000 in ordinary dividends, then that $2,000 will be added directly to that $30,000, making your total taxable income $32,000. Now let's pause for a moment, because I think it's important to understand how our federal tax brackets work. If you already know how they work, great, you can go ahead and skip to the time up here. But for those of you who don't know, the US has a progressive tax system, meaning that the higher your income goes, the higher your tax rates go. Now, our tax system is also marginal, meaning the income we earn is split up into segments, and each of those segments are taxed at a different rate. For example, if you earn $90,000, that $90,000 will be split into 4 different segments. The first amount will be taxed at 10%, the second amount taxed at 12%, the third amount taxed at 22%, and the fourth amount taxed at 24%. So if we add up the tax paid on the amounts, we come up with a total of $15,774.50. Now, if we take that total tax and divide it by our initial income, we end up with a 17.5% average or effective tax rate. So even though $90,000 would put you in the 24% marginal tax bracket, you would only be paying around 17.5% on your total income. Alright, so now that you know how our federal tax system works, let's talk about qualified dividends. Unlike ordinary dividends, qualified dividends are taxed using the long-term capital gains rates. These rates are 0%, 15%, and 20%. Now the long-term capital gains rates are based off your taxable income. What this means is if your taxable income, which includes qualified dividend income, is below $39,375, then you will pay 0% on those qualified dividends. Now, if your taxable income is between $39,375 and $434,000, then you will pay 15% on your qualified dividends. And of course, if you're making over $434,000, then you will pay 20% on your qualified dividends. One other thing to note is if you make over $200,000 in modified adjusted gross income, then you will have to pay an additional 3.8% on your qualified dividends through net investment income taxes. Now let me give you an example to make this all come together. For the purpose of this video, let's assume that all figures are post-deductions. Let's say that Joe makes $25,000 from his job and makes an additional $1,000 in ordinary dividends and $1,000 in qualified dividends. Joe's ordinary taxable income is $26,000 and his gross taxable income is $27,000. So let's calculate what Joe's effective tax rate is so we can determine how much of his ordinary dividend income he'll keep. First, we take Joe's ordinary taxable income and subtract $9,700. Then we multiply that amount by 12% to get $1,956. Then we multiply the remaining $9,700 by 10% to get $970. Now we add our amounts together to get $2,926 total tax. We then divide this number by 26,000 to get an effective tax rate of 11.25%. We then multiply Joe's ordinary dividend income by this rate to get a total tax payment of $112.50. Finally, we subtract this amount from 1,000, which leaves us with $887.50 of ordinary dividend income. Now, if we look at Joe's taxable income, it is less than $39,375, so he will keep all of his qualified dividends. Joe's net dividend income is $1,887.50. Now, as you can see, if Joe's dividends had all been qualified, he could have saved an additional $112.50. So now that we know that qualified dividends generally provide us with a better benefit, how do we determine if our dividends are qualified or not? Well, the IRS actually gives us 3 conditions that need to be met in order for it to be qualified. Let me give you the conditions and then I'll explain them. First, the dividend must have been paid by a US company or qualifying foreign company. Second, the dividends are not listed with the IRS as those that do not qualify. And third, the required dividend holding period has been met. Now, for a foreign company to be qualified, it needs to meet one of 3 requirements. Either it's incorporated in a US possession, or it's eligible for benefits of a tax treaty with the US, or its stock is readily tradable on a US securities exchange market. Now, this last requirement is really the easiest way to tell if a foreign company is qualified or not. If you buy its stock on a major US securities market, then it's qualified. Now, moving on to the IRS's list of dividends that do not qualify, we have real estate investment trusts, master limited partnerships, employee stock options, tax exempt companies, money market accounts, and certain foreign companies. Now, the final condition that must be met for a dividend to be qualified is the holding period. Now, the holding period is a set number of days that a dividend must be held in a given time period. Now, the number of set days that you have to hold a dividend is 61 days. Now, the 61 days has to be within a 121-day time period. This time period starts 60 days before the ex-dividend date. Now, what this means is all you have to do is buy the stock 1 day before the ex-dividend date. And as long as you hold it for the following 61 days and don't sell it, all your dividend payments will be qualified. And there, now you know how to tell if your dividend is qualified or not. Finally, let's talk about Form 1099 DIV. This is the form that you will receive either from your brokerage or from the companies that you bought stocks from. Now, this form has the total amount of dividends paid from a company, and you'll use it to fill out your Form 1040. Now, in Form 1099 DIV, Box 1A, even though it says ordinary dividends, it actually includes both qualified and ordinary dividends. This is because your Form 1040 will use this amount to calculate your gross income. Next, it takes your qualified dividends and places it in Box 1B. So once you receive all your Form 1099 DIVs, you'll enter that information into a Form 1040 Schedule B. So I hope you guys found this video to be helpful. If you enjoyed it, be sure to give it a thumbs up. Also consider subscribing if you haven't already done so. Thank you guys so much for watching, and I will see you in the next video.